Good afternoon, and welcome to the 2020 Market Update hosted by CARW and NAIOP Wisconsin, presented by First American Bank. I'm Pam Tourer, Senior Vice President of First American Bank and the 2021 NAIOP Wisconsin Board President. First American Bank is a $6 billion commercial bank with retail operations in Wisconsin, Illinois, and Florida. Our commercial real estate portfolio includes assets both in local markets and nationally, with a diversified mix of single-family, multifamily, industrial, office, and mixed use. We provide both construction lines and permanent financing. First American Bank is honored to sponsor the market update, along with Altius Building Company and Wisconsin Crew. We really appreciate their financial support of this important industry event, and of course, appreciate all of you for tuning in. The market update is truly a collaboration between not only NAIOP Wisconsin and CARW, but also our presenters, their teams, and our data guru, Nate Winkle with Newmark. Thank you to all of them for helping to make this year's event as interesting and informative as always. While I will miss our celebration after the presentations this year, I am extremely grateful to be able to visit with you virtually today to take a moment to reflect on so much great work that has transpired in the commercial real estate industry this past year, despite unthinkable obstacles. So now, whether you are in your office, your home office, viewing from the couch, sit back, relax, maybe grab yourself something enjoyable to drink, and get ready for an outstanding program. We begin with a presentation on the office market. Our presenter is Ben Anderson, founding member of Colliers International, Wisconsin's Occupier Advisors Group. Ben is a leader in business development, active pursuits, and deal volume, and has completed nearly 2 million square feet in transactions with a primary focus on tenant representation and occupier services. Please welcome Colliers' Ben Anderson.
Thank you, Pam. 2020 certainly was an interesting year for the office market. Digging into the numbers, you won't notice anything out of the ordinary. There was a modest 3% increase in overall vacancy rate, which can mostly be attributed to new product deliveries such as BMO Tower, Huron, and River coming online. So how has the pandemic impacted the market? As the numbers outline, commercial real estate is a lagging indicator, and due to longer-term leases and lengthy decision-making processes, vacancy rates are not substantially impacted in the short term. Activity and occupancy of those spaces, on the other hand, certainly have been. To put things in perspective, the 833 East Michigan building, the building that we office out of, pre-pandemic saw upwards of 1,000 people coming out of it on a daily basis. During COVID, that figure has been closer to 150, and that's about the average for what we're seeing downtown. Now, comparing 2020 to our historical data, we're seeing almost a 50% decrease in lease activity, with the average term and deal size decreasing by almost 25% apiece. Uncertainty in returning to the workplace, along with virtual employee engagement plans, have resulted in shorter-term leases and less physical office expansions. Uncertainty is the theme of 2020, and true to its form, it's caused a decrease in demand for longer-term leases and larger footprints while companies wait out the impacts of COVID. Along with increased safety concerns around airflow, touch points, density, there's been a massive decrease in demand for downtown office space as users look towards low-rise alternatives found in the periphery of downtown and in suburban markets. Now, prior to the pandemic, 2020 continued along with the momentum from 2019, and we saw a very strong Q1 with a number of notable transactions, including Milliman and Hydrite being announced in the corridor for a combined 163,000 square feet, the 40,000 square foot relocation of Ross Innovative Employment Solutions in the North submarket, and North Shore Healthcare relocating from the North Shore to downtown Milwaukee. The larger transactions significantly fell off in mid-March. However, activity picked up in the second half of 2020 with a few sizable deals, including the announcement of Johnson Bank and Kaler Slater relocating within the Central Business District, and Mindful Staffing Solutions making a considerable expansion in the relocation within the North submarket. So office market disruptors. So over the years, we've seen generational trends disrupt the office market. Rewinding to the 1980s and 1990s, the suburban lifestyle draw led companies to locate in the suburbs to capitalize on the talent concentration. Jumping to the 2000s and following the talent pool, companies flocked to downtown to capture the millennial population that looked to fully utilize the live, work, play model. As we fast forward to today, rather than the fight being between the suburban and the urban, the main disruptor is the ability to work anywhere. This non-geographical component has altered what was the traditional decision-making process for companies. The ability to work from anywhere, combined with the challenges facing companies in the immediate future on how to bring employees safely back to the office, has caused a shift in the tenant decision-making process. Prior to the pandemic, the goal was to determine the culture of the organization, identify the best area in town to attract that talent that fits that culture, and find the best space and building that accomplishes those goals. As we shift to today, and the first question of culture remains the same, but the added questions of how do we operate as an organization and how can we ensure employee safety are added to the mix. The decision now isn't necessarily which part of town should we operate in, but should we have a physical presence at all, a reduced presence, utilize co-working space, leverage sublease space, or stick with traditional office, all while maintaining our culture and that work dynamic. So it is a tenant's market. To add to the changing mindset and intangibles that companies now have to consider, and to further impact the decision-making process, tenants have more options than ever in the market. When I had first started in the industry in 2012, the downtown Class A vacancy rate was around 7%. And if you were a company looking for 10,000 square feet or more, you would be limited to only a handful of options. Fast forward to today, running a quick search around the same parameters results in 24 viable building choices. As a tenant, the challenge is no longer to find space, but in narrowing down the options. Also, a key item to note is there's availability in U.S. Bank, which we have not seen in the last 7 years of any significance. So what's the value proposition? So for all the landlords in the room, there's hope. While serving a slightly lesser impact, location is still a major driving factor in the decision-making process, and tenants are still drawn towards amenity-rich buildings. Yes, even though they're closed, your common area fitness center is still part of the decision-making process. So in times of uncertainty, the value proposition of landlords needs to respond accordingly. That means quick and aggressive responses and the ability to react in nimble and creative ways. Simple ads like hand sanitizing stations and HVAC assessments go a long way. And while negotiation will always be part of the process, respond with your best foot forward. Remember, companies have more options now than ever, and their goal isn't to keep every site in contention, but winnow it down to a finalist, and the economics will remain a driving force. So how did Jim do? Looking back at Jim Kavanaugh's predictions from 2019, you'll note that he did not predict a pandemic. Maybe you'll get it right next time, my friend. Pfizer will relocate downtown. They haven't yet. Maybe 2021 will be the year. A major corporate tenant will announce a substantial suburban development. The corridor was kicked off in Brookfield, so you nailed this one. And the DNC will be a brokered convention. Unfortunately, the DNC wasn't as large a part of Milwaukee as we would have liked, but if by brokered you meant that the DNC was repped during their hunt for office space, then you're spot on. I'll give you 50% credit. Looking ahead into 2021, where do I feel the office market is going? For starters, office isn't dead. There will continue to be increased interest in the suburbs, lower-rise buildings, and single-tenant sites. A vaccine will become readily available by summer 2021, leading the majority of companies to return to the office at full capacity. Demand for office space will increase significantly in Q3 and Q4. And finally, and maybe most importantly, Giannis will lead the Bucks to the NBA Finals. Pam, back to you.
Thank you, Ben. We move next to the industrial market. I am pleased to introduce our next speaker, Adam Matson. Adam is a director in the Milwaukee office of Newmark and specializes in the sale and leasing of industrial buildings and land for both users and investors. In the past 10 years, Adam has leased more than 5 million square feet. Please welcome from Newmark, Adam Matson.
Thank you for the introduction. 2020, what a year. It's absolutely amazing the changes and challenges that we have seen in the industrial market, not just across Wisconsin, but globally. We've run into employee issues, supply chain disruption, and shutdowns. Yet, through all of that, we've seen rampant growth in our sector. My focus will be Southeastern Wisconsin, and I'll try not to spend the entire day on Amazon. The industrial market in Southeast Wisconsin grew by almost 6.5 million square feet. Vacancy raised just a bit, which shows some of our growth was purely speculative in nature. Most of our growth was what we call big box. These are typically large distribution centers. 17 buildings in our tract set accounted for 6.5 million square feet of growth. Now, I'm sure you're asking yourself, where's the growth coming from? Well, that is why I'm here today. I call this inorganic growth. A lot of our new business comes from out of state, whether we are pulling from Illinois or bringing the supply chain back from China. We also have a cap rate compression issue, which means lower returns and higher prices. So local investors have been on the sideline as REITs and institutional money fight for our product. Why is this, Adam? Well, an effect we have in Wisconsin, and we have fought it for years, was the Chicago effect. Everyone called us Chicago or tied us to it. I think we need to embrace it. Illinois has become unstable and expensive, although still desired. Corporate site selectors globally have tagged Milwaukee-Beloit as a submarket of Chicago, allowing for greater exposure and absorption. It's the year of taglines. We want to be staying flexible. To survive in this market, we've watched companies flex and change much quicker than they did 10 years ago. Relocation from out of state has increased to take advantage of tax rates and employee expenses. Relocation in the state is happening now to take advantage of rent discounts, distribution chains, and building efficiencies. Companies are moving from old business parks and functionally obsolete buildings to new construction with freeway access, higher ceilings for stacking, laser-leveled floors, and increased dock availability. Companies are bringing back warehouse and manufacturing due to the supply chain challenges and to ensure stability in the future. We are also seeing the elimination of third parties for work that can be done in-house. This could be painting a line or even invoicing. Contrary to that, companies are also eliminating internal warehousing for additional manufacturing, outsourcing warehousing to third parties, or leasing additional facilities. Essentially, they are moving out product to bring in the machines. This has led to quite a bit of absorption in the market, but has shortened the average lease length. We're all just stuck in the bubble. As brokers and service providers, our businesses have functionally changed as well. Zoom doesn't mean I just need to go fast because I'm late for a meeting, which I probably am. Our meetings and even our building tours are switching to online. Almost all of our projects are now accompanied by a drone and a video tour. Some space is even being sold and leased without physical tours by our end users. Most of our industrial buildings come with some level of office space. Our customers are still working on space planning, and we are watching them struggle with the decision to create more private offices or create increasingly larger open offices, allowing for appropriate distancing. This is changing the layout and expense of our build-outs, potentially increasing average rates in the market. And here it is, the Amazon effect. I'll let Gretchen get into the sales with her capital market discussion, so I'll hit on a few of the recent leases, or leases in progress. Amazon is moving forward with plans to lease the former JCPenney distribution site on Highway 45 in Burleigh from Phoenix investors. This will be a prime location. They have plans to demolish 350,000 square feet. That's 8 football fields just for parking. They'll also remodel another 540,000 square feet. They just broke ground on over 1 million square feet in Beloit, started occupying 2.6 million in Oak Creek, that's 60 football fields, and they also leased another 1 million square feet from here to Madison. The central market saw a decrease in just over a point for its vacancy. The numbers you see are not fair to the market. The market here does have its challenges due to older buildings and its heavy manufacturing roots, but the old JCPenney site accounts for 2.2 million square feet, with a large chunk of it being vacant in our tract set. By the next market update, I think you'll see a significant and positive change. The North saw a change of a little over 1% in its vacancy. This is an often forgotten market, and I wish it wasn't. Demand lags a little in the North due to its distance from the Zoo interchange and heavy traffic in the metro. Most of the growth in this region is organic, or it comes from companies already in the area. The always popular West Market. The West Market is our local darling that sees, outside of Kenosha, the most demand, investment, and growth. It's popular due to access to skilled workers, quality buildings, and immediate access to the freeway system. We saw a change of 100,000 square feet of additional vacancy. The South is always interesting. Year by year, we can watch vacancy and demand jump and drop and bounce and change. This region used to be dominated by demand for the Mitchell Airport, but we have watched it change as Racine has grown to compete with Kenosha, and the Oak Creek Franklin markets have provided Class A distribution buildings to service the airport district and Illinois. The South market grew by 2.5 million square feet and added 3% to its vacancy rate. Just like Amazon, I could have spent the entire time on the submarket of Kenosha. There is constant demand and growth from companies looking to locate here. We've seen companies locate here specifically to fight COVID and produce sanitizing products. We've seen absorption in last mile requirements, and we've watched manufacturers move entire companies into Wisconsin to take advantage of our labor pool, stability, and tax rates. Kenosha saw an additional 2.6 million square feet of inventory, but a 2.4 decrease in vacancy. This chart is interesting as the amount of sale transactions decreased, the actual transactional volume increased. These are a few of our larger investments in the region. We don't need to focus on these as it's more of a capital markets discussion, but it's important to note that these occurred prior to the COVID shutdowns. Here are a few of our larger owner-user sites from 2020. It's good to be a business in Wisconsin. And now for everyone's favorite part of the event, the predictions. I have the honor of following Tony Haining from JLL, who somehow did not predict the COVID effect of 2020. Hello, Tony. New business park developments will increase in areas we never thought we'd see development, such as Germantown, Franklin, Big Bend, etc., etc. Well, I think Germantown and Franklin would not be happy to hear that since they're pretty well established. What I think he means is on the outskirts of their existing parks, and he was correct there. And was he ever correct in the outlying areas? Big Bend has a Zilber development going on. Bristol saw HSA breaking ground on a 68-acre industrial park. McQuantigo has pretty much filled up its newest industrial park. Salem secured 2 tenants for build-to-suits occupying 160,000 square feet. And Cedarburg secured Willow Pump's new development. Next prediction, new deliveries will continue to outpace absorption. Correct. Next prediction, Strauss will reconsider their plans to locate in central Milwaukee. I guess this is true, but Milwaukee reconsidered the plans for them. It's on track for now in Franklin, but there is a lawsuit in place, so I am not offering any predictions on this one. Vacancy will rise at a modest rate, bold prediction and true. The Bucks will win the NBA championships. Can we blame this on COVID, Ben? Ben, I'm blaming this on COVID. And now for my predictions. Amazon and big box distributors will continue to expand in Wisconsin. Another bold prediction. Investors will be very busy buying and selling our Class A distribution buildings, but leaving manufacturing behind. Most of this will be from out-of-state investors, particularly REITs and institutional buyers. Manufacturing will continue to expand and decline. We'll see an increase from out-of-state manufacturers, but limited organic growth for a short time as we work our way through COVID challenges. Illinois to Wisconsin trend will continue, the Central's vacancy rate will fall substantially, and the Pack is going to the Super Bowl. And that's it. That's the Wisconsin industrial market in under 12 minutes. Back to you, Pam. Thank you.
Thank you, Adam. Moving from industrial and e-commerce to the next market, retail. I'm pleased to introduce our retail presenter, Kelly Rodenkirk. Kelly is a real estate advisor with Cushman Wakefield Berkey Company. Please join me in welcoming Kelly to present the retail market.
Thank you, Pam, and thank you to CARW, NAIOP, and our generous sponsors. Before I get started, I want to do a quick shout out to Nathan Powers for all of your help over the years and pushing me, or should I say, encouraging me to do the market updates. Today, I will be talking about Southeastern Wisconsin retail stats, notable deals and developments, retail trends and expanding retailers, and lastly, my predictions for 2021. Okay, let's jump into the stats for Southeastern Wisconsin. The total retail gross leasable area is at 42.6 million square feet. That is up about 200,000 from last year. Total occupied space of 38.9 million square feet, leaving 3.7 million square feet of current vacant space. With the calculation, the vacancy rate for 2020 comes out to 8.8%. To put that into perspective, the vacancy rate for 2019 was 7.3%, and the vacancy rate for 2018 was 7.7%. We continue to see big box retailers closing, and we have seen numerous local and national retailers shut their doors over the past year. These all are contributing to the 8.8% vacancy rates. Moving on to retail trends. Like mentioned before, we have the big box retailers are continuing to close and being repurposed for their next chapter of life. We have retailers developing ways to make the experience as convenient as possible for customers. We are seeing banks and credit unions expanding like crazy with a focus on small footprints, more locations, and in a very visible retail corridor. And we are seeing retailers struggling, not only national, but we're also seeing local retailers struggling more than ever right now. Just remember to shop local this holiday season. Now let's take a look at some notable deals and developments around the city, starting with central retail markets. We have the Couture that was just recently got approved financing. The Couture has a completion date of spring 2023. This development will be a 44-story building with 42,000 square feet of retail, 322 apartment units. Moving on to the Deer District, we are continuing to see expansion over there. We have the Milwaukee Public Museum and Betty Bryn Children's Museum locating to the corner of McKinley and 6th Streets. We have the Bucks partnering with a Matson developer to deliver a 200-room hotel directly north of Pfizer Forum. It will be a Marriott International Autograph Collection. Heading to Walker's Point, we have River One development over on 1st and Beecher. Within this development, we have 19,000 square feet of retail space, a 125-room hotel, 95 apartment units, and 268,000 square feet of office space. Also in this little pocket of Walker's Point, we are hopefully going to see a lot more development right here on the river. Heading just east, we have Wheel and Sprocket with their recently completed Bayview location. The Bayview location is aimed to be the coolest bike shop in the world that offers full experience to customers with retail space, a cafe, and community space that can be rented out. This is a great example of repurposing a 100-year-old industrial building into a retail use. Heading a little bit more east, right over KK, we have the Kinetic Apartment building with Flower and Feed Food Hall, and their first announced tenant is Gathering Place Brewing Company. This will be Gathering Place's second location. Their first one is in River West. At the Bayview location, there will be a tap room and small production. This is slated to open in 2021. Moving up to the north retail markets, I think one major development to highlight up there is Bayshore. The two retailers I'm most excited about are a 128,000 square foot two-story Target, which is being proposed. An exact delivery date has not been announced yet. And Total Wine, which opened early September. And I mean, I can't lie, I've been there a couple times for market research. We also have Eric's Bike Shop relocating from Silver Spring in Whitefish Bay to Bayshore Mall. And there are also plans for an additional 300 apartments and a hotel are in the talks. An interesting point I want to make about Bayshore Mall when it comes to retail there is that with them tearing down the interior portion of the mall and the food courts, that brought triple net expenses, which triple nets cover your common area expenses, your insurance, your taxes, and your landscaping. That brought down the triple net expenses from around $43 per square foot to an estimated $13 per square foot. This is huge, especially for local retailers that are on a tight budget and still looking to expand to Bayshore Mall. In line with the trends I spoke about earlier, we are seeing large format restaurants closing their doors. The former Perkins on North Port Washington Road in Glendale is being backfilled with King Crab Shack, who currently has 2 existing locations throughout Milwaukee. Also in line with the trends, we are seeing banks and credit unions expanding to highly visible retail corridors and paying top dollar for these sites. We have Chase Bank over in Whitefish Bay. We have UW Credit Union, who purchased the former Pizza Hut on North Port Washington Road for $1.6 million. We have Landmark Credit Union, who purchased 1.47 acres for $2.5 million on North Port Washington Road, just north of Bayshore. They also purchased land to develop a store or a location in Mequon, right on Port Washington Road across from Sendik's. We have Associated Bank, which is part of the Nicolay Soccer Field redevelopments with a 2,900 square foot branch. And they also are relocating their Mequon store just directly south on Port Washington Road. Heading over to Grafton, this is a great example of repurposing big box stores. We had Best Buy vacate Grafton Commons, and they quickly backfilled that space with Five Below and TJ Maxx. Moving to the northwest side, we have the Asian market that is expanding their footprints with a $20 million investment to expand and update the current building. The finished project will be 115,000 square feet of market, grocery, and food options. I have to say I'm excited to check that one out once it's completed. Heading to the Mequon public market, I wanted to highlight the public market because we recently had vendors such as Bowls, Beans and Barley, and Bavette vacate the space, but it was quickly backfilled with Pizza Man, Falafel Guys, and Aloha Poke. Heading to the west retail markets, continuing with one of the retail trends of 2020, repurposing big box stores, we have West Dallas, the Pick and Save on Greenfield and Highway 100, which was purchased by Festival Foods. Out in New Berlin, we have the former Walmarts that went to auction and was purchased by Burghardt Sports for $3.26 million. They will be consolidating their operations and retail stores into that space. They then went around and sold a portion of the building and land to the city of New Berlin for a new community rec center. On the topic of big box stores, we have the three former Boston store locations, Mayfair Mall, Brookfield Square, and Southridge, that went to auction at the end of October. The three properties did not make the reserve bid and are continuing to be marketed by CBRE. The properties did not make the reserve, but the ending prices were $6.8 million for Brookfield Square, $5.6 million for Mayfair, $3.4 million for Southridge. Going forward, it's going to be interesting to see what these properties develop to be. Continuing with Brookfield Square Mall, we had Luminaldi's. They backfilled the 7,400 square foot Stir Crazy space. We had Herzing University relocate to the former 23,000 square foot Fresh Time Markets. This is another great use of repurposing a big box store. Heading to the corners of Brookfield, we have not seen any new developments last year there, but across the street we are seeing continued proposed expansion of multifamily, with Wimmer purchasing elite sports clubs on Barker and Bluemount. Heading out to Mayfair, we have the office building on the corner of North Avenue and Mayfair Road that was redeveloped to a Renaissance hotel. They have an in-house restaurant of Elder and Rhyme. Now jumping on over to Mayfair Collection, we had a couple closed restaurants this year of Osgood's, Cafe Grace, AJ Bombers, and El Jefe. New restaurants at Mayfair Collection consist of Golden Nest Pancakes and Cafe, Grab It Your Way, and two local restaurants are backfilling vacant spaces, but I'll let them announce that to themselves. We've also seen Serendipity Labs. That is a co-working space that is taking over or took over the 32,000 square feet on the first floor of the apartment building at Mayfair Collection. Also in the west suburbs, we are seeing the expansion of medical use, which is in line with the trend I stated before of convenience. We have Orthopedic Associates of Wisconsin proposing a new clinic at Brookfield Square. And we also are seeing Froedtert and the Medical College open their first neighborhood hospital consisting of 18,000 square feet in New Berlin on Moreland Road. These are not your typical retail uses, but they are being developed on highly visible land. Heading to the South retail market, I already highlighted the Boston store at Southridge, but again, this is an interesting developing story. The Village of Greendale stated that this property was blighted, which hurt the outcome of the auction sale. There was less interest in the property, with potential buyers not knowing if Greendale would possibly take the property from them against their wishes. This is another interesting story, and we'll see how that plays out. Touching base on common trends I stated previously, we have the former Target on South 27th Street, which was purchased by Festival Foods. We have the former Toys R Us, also over on South 27th Street, which was purchased by the ethnic grocery store Monterey Markets. They have another location on South 13th Street. We have seen quick service restaurants going up right and left. Of course, a majority of them incorporating a drive-through for the customer's convenience. We have Panera that backfilled the former Boston Market at Point Loomis Shopping Center. We also have Burger King, who opened a location on South 27th Street and Euclid Avenue with a drive-through, to name a few. Like previously stated, we have Freighterts and Medical College once again expanding their neighborhood hospitals to Oak Creek with Drexel Town Square. That expected delivery date is 2022. We are seeing quite a few developments on South 13th Street and West Drexel Avenue, just east of IKEA. We have Summit Credit Union proposing a 37,000 square foot building. We have Milwaukee Yards, which is a 100,000 square foot sports complex. This will be the third indoor sports complex of the brands, with the other two in Illinois. And we currently have Hub 13 under construction, which is a 300-unit apartment building being developed currently. Heading west over the freeway in front of IKEA, we have another 143-unit apartments being developed, along with 2 hotels, a conference center, and a retail strip center. Moving on, just wanted to touch quick base on expanding retailers. I know I mentioned a couple of these throughout the presentation already. I wanted to give a subtle plug to the retailers that I currently work with. For Jiffy Lube, Sally Beauty Supply, and Clean Laundry, they are all currently looking for sites, so if you have any, send them over. I'd love to discuss further. Switching gears to local retailers, I thought it would be interesting to highlight a couple businesses that have evolved due to COVID. One major change we are seeing is curbside pickup or delivery. We are seeing restaurants incorporating a grab-and-go and grocery concept. A good example is Don's Diner. They incorporated a concept of Don's Grocery and Liquor to their usual operation. We also have Voyager on East Lincoln in Bayview. They have shifted their operations from wine and cocktail to focusing on sales of wine and food to take home. Some other notable changes over at Chef's Table. They have moved from large events to small, intimate, private dinners. We are seeing expansion of outdoor dining when it comes to domes, yurts, heaters, whatever it is to keep the diners outside for as long as possible. And some listed on the slides of retailers that are focusing on that. We are seeing Milwaukee Ballet and similar venues are streaming performances for a cost, trying to deliver the arts while staying afloat. One thing I want to touch base on is a new app that we are seeing used at Mayfair Mall and other retailers such as Lululemon is Spot Holder, where you can virtually wait in line for your opportunity to shop within the store. Moving on to Max Jacobson's predictions for 2020. He said that several of the boutique fitness concepts will be closing their doors. This can kind of go both ways. Right now, we are not seeing too many of the boutique players closing their doors, but we are seeing larger format gyms struggling, such as YMCA downtown, they closed, and several Anytime Fitnesses around town. His next prediction was marijuana will not be legalized in Wisconsin. Max was right on this one. It will be interesting to see what direction we go in the future. And then he says that leasing velocity at the Deer District, parentheses Bucks Arena, will skyrocket after the Bucks win the NBA 2020 championship. Unfortunately, the Bucks blew it this year in the playoffs against Miami Heat. Moving on to my predictions, I predict that vacancy rates will continue to increase throughout southeastern Wisconsin. I predict that local restaurants will continue to close, but they will come back stronger than ever. And lastly, please, 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 in 2021, please bring the end of virtual happy hours. And back to you, Pam.
Thank you, Kelly. Great presentation. Our final segment today is the investment market. Here with us today to present is Gretchen Richards. Gretchen is Vice President with CBRE based out of Madison. Gretchen specializes in multifamily investment sales and is a part of the capital markets investment property team since joining CBRE in 2016. Gretchen has participated in approximately $164 million in investment transactions. Please welcome CBRE's Gretchen Richards.
Thanks, Pam. Let's dig right in with capital markets and investment sales. 2020 will be memorable, to say the least. From an investment property standpoint, this year will end with a resounding, not as bad as we thought. In fairness, the degree of not as bad varies greatly depending on what product type is owned and where it is in the lending cycle. And no question, it's a really challenging time for certain sectors, and I don't want to make light of that. However, there's always a continuum, and some product types fall in and out of vogue for any number of reasons. We all know property is static, and it's people who energize spaces, and this is what makes 2020 so fascinating from a commercial real estate perspective. People are moving and buying goods and services, or rather not, all very differently right now, which dramatically impact the demand for various investment sectors. More than anything, 2020 significantly accelerated trends which were already underway. Today, we'll cover the state of the economy, top transactions in each sector, and trends that they represent, and everyone's favorite, predictions. Let's start with the economy. The US economy entered a deep recession due to the COVID-19 pandemic, with the GDP plunging over 31% in second quarter. The good news, full-year GDP is expected to be down only 4%, followed by a 4.5% rebound in 2021, which is anticipated to bring the US GDP back to pre-COVID levels in the third quarter. The $2.2 trillion economic stimulus package was extremely effective in stabilizing the US economy. A second stimulus package in the near term would greatly benefit retail with consumer spending and multifamily with rent payments. A strong fiscal response will also lay the foundation for more rapid recovery, though we know some real estate sectors will lag behind, particularly office, retail, and hospitality. The Federal Reserve recently announced it would allow inflation to move above the 2% target for several quarters after periods of low inflation. The Fed likely will take a much more patient approach to rate hikes, essentially ensuring a lower for longer rate environment as the economy recovers. For commercial real estate, this will likely translate to downward pressure in long-term cap rates. Though low interest rates are generally good for commercial real estate, there could be other impacts not widely considered. For example, banks could require more reserves or tighten underwriting standards to maintain financial stability and therefore impact loan-to-value ratios. And we saw that during the pandemic early on. That said, the Fed plans to keep interest rates near zero until 2023. At the same time, real estate cap rates have remained relatively stable. This rewards investors with a wider yield spread and additional asset value appreciation. The low-yield investment environment makes real estate highly attractive on a relative basis, and there's a significant amount of dry powder on the sidelines. As you can see, Wisconsin's year-to-date volume has retail, office, and multifamily clustered in the 15 to 20% market share of sales. Clearly, industrial is the market leader with nearly half of the transaction volume for Wisconsin. Across all sectors, net lease investments have been extremely popular and see tremendous bidding activity. So who's buying? Really active purchasers include family offices and other ultra-high net worth investors. Private capital makes up nearly 70% of the buyer pool, and this is pretty consistent with last year. During the pandemic, life companies and REITs moved to the sidelines. The institutional and REIT figures shown here are primarily representing the robust industrial market. In total, Wisconsin transaction volume is down 44%. Industrial is up 3% from 2019. However, multifamily is down 49% from last year, and both retail and office were each down 64%. Granted, I'm comparing year-end 2019 with year-to-date numbers, and more deals will close in December. Even so, the industry is down. Let's take a look at some transactions and the trends that they represent. Starting with industrial, the CenterPoint Properties portfolio sale at nearly $269 million tops Wisconsin transactions by volume. This deal closed in February and was a portfolio sale, of which 14 of the properties were in Wisconsin. Industrial continues to trade very aggressively across product types, including sale-leasebacks and multi-tenant buildings. The CenterPoint deal is a clear standout and an indicator of the momentum of portfolio deals. The Kenosha Amazon sale by Prologis to KKR, which closed in June, is also notable at $176 million and an approximate 5.3% cap rate. Without question, there's an Amazon effect within the industrial sector, and during the pandemic, it is estimated e-commerce strategy leapfrogged by 3 years. Single net leased properties and suburban grocery-anchored centers will continue to be the most resilient within the retail sector. The Oconomowoc Fleet Farm deal, which closed in January, is a prime example of net lease assets. This pre-COVID deal was purchased by SR Realty Trust based in Minneapolis and sold by Commercial Horizons out of Green Bay. This traded for about $36 million at a 7.25% cap rate. Another great example is the Menominee Falls Super Pick and Save, which traded for $28.4 million and at a 6% cap rate. Both deals are prime examples of the strength of the retail net lease environment, which has seen cap rate compression of about 25 basis points since the pandemic began. There's a flight to quality in retail, and cap rates are ranging anywhere from 6 to 9%. And on to my favorite asset class, multifamily. Lafayette Apartments in Fitchburg closed in February for $38.8 million, although that's not the whole story. This was part of a 3-property portfolio in the Matson MSA, and in total, traded just shy of $97 million. Widener Properties, based in Kirkland, Washington, was the buyer, and the seller was Cascade Development. This is a great example of a core plus suburban asset sale. This portfolio included newer construction, and Lafayette Apartments was not even stabilized at the time of sale. There's an even larger contingent of buyers looking for what is called value-add properties, in which the buildings are a little older and investors renovate the units in exchange for higher rents. While value-add underwriting saw some tweaks early in the pandemic, it's back to business as usual with large bidding pools and aggressive cap rates. For example, we're marketing a 72-unit asset in Pewaukee, which will be entirely vacant at closing, and we had 25 offers for a vacant property during a pandemic. Just as CBRE was the first to bring Widener to the market in 2017, new capital is pouring into the Midwest for multifamily, and especially Madison and Milwaukee. A 5% cap rate here looks very attractive to investors compared to a 5.25% cap rate in St. Louis or Columbus. And finally, office. Within the traditional office sector, there's a bifurcation in the type of asset that's attracting interest, with a strong demand for core properties, but a diminishing interest in value-add and multi-tenant properties. For our purposes, the top 3 office transactions were in the alternative office categories of medical office and life sciences facilities. The Aurora Healthcare facility in Greenfield was sold by Cobalt Partners to Montecito Medical for $74 million in November. Excelsior Group sold the Freighter North Hills Health Center in Menominee Falls to IRA Capital for $59.3 million in October. Also noteworthy was the 2-property portfolio sold to Sarah Investment Real Estate by the Gialamas Company in Madison for $23.5 million. These 2 buildings house Accuray, which is a life sciences company focused on cancer treatment therapy. Let's take a look at Adam Connor's predictions from last year and see if they held true even in the face of the pandemic. So first, cap rates will remain flat for 2020. False. The blended cap rate went from 7.3 to 7.9%. Multifamily saw cap rate compression, whereas industrial, office, and retail all saw cap rates increase. So transaction volume will be down versus 2019, but not by much. False. While we were down by quite a bit. Based on the data Adam used last year, the Milwaukee market is down 41%. So I'm going with the false on this one. Granted, yes, it's down, but you know what I mean. Infrastructure investment will continue to spur more development. True. On a positive note, some infrastructure projects were expedited during the pandemic since no one was around and the work could be done more efficiently. I don't think development taking place right now is due to these infrastructure improvements, but I agree that it will continue to catalyze projects into the future. And then lastly, there will be some record cap rates that hit for net lease and apartments in Q1 and Q2. And this is absolutely true, and I'm seeing it in my own business. For example, 1910 on Water, the 68-unit apartment building in downtown Milwaukee, was a sub-5 cap rate on tax-adjusted T12 numbers. And finally, it's time for my predictions. Adaptive reuse of existing assets will be on the rise. Specifically, office, hotel, and retail will see the most adaptive reuse. The former Target on Brown Deer Road converted to cold storage is a great example for retail. While my answer for most questions is multifamily, it's really true for CBD office and hotel. The Jeffers redevelopment of the Journal Sentinel property is a model case. Getting people into places solves most real estate issues, and adaptive reuse will help get things going. Secondly, further cap rate compression for industrial and multifamily. Our Midwest multifamily peers continue to see a 4 cap rate environment, and we will continue to follow suit. Industrial cap rates will also wow the market. And next, 2021 transactions will be near 2019 levels. While sellers are by choice or by necessity, the result is the same. We're going to see more product. Pent-up demand is also a holdover from the lack of inventory from 2020. Net lease demand will continue to increase, and lastly, portfolio sales will be on the rise. And finally, my biggest prediction is that 2021 will be significantly better than 2020, and we'll be able to take a real vacation.
Well, that was fun. This market report was so important with all the changes going into 2020 and 2021. Through everything we had, Gretchen, I loved what you had to say, but I actually have a question. Do you mind if I ask?
Please do.
So with the cap rate discussion we've been having, is there a chance that Wisconsin is going to slowly turn into the West Coast markets where instead of yield and percentages, they're actually chasing appreciation?
Well, as much as, we love the California weather, I don't think Wisconsin will ever be California. I know from multifamily specifically, we have a lot of coastal investors who are flooding the Midwest with the hope of chasing yield. The coasts are just really a challenging environment, and a lot of people are coming into the Midwest looking for deals and really kind of recalibrating their focus to include Midwest properties. So is that what you're hearing in industrial, Adam?
Yeah, we always lag a point or two behind multifamily. And a lot of our investors have asked the question because we've seen them chase in California, Washington, even a little bit on the East Coast, purely deals missing the yield. And we just are hoping we have a good run here in Wisconsin and we can go a few more years without following that. So yeah, I think we're seeing the exact same thing that you are.
Yeah, I think it's a ways out still. I am glad you asked that though. Thank you. I do have a question for Ben. Ben, with all of the activity in the office market, what are you seeing as far as subleases?
Yeah, absolutely. I mean, we're seeing a flurry of sublease spaces hit the market. In the third ward alone, we have about 40,000 square feet. I think Chase Tower has around 55,000 square feet, and 411 has about 46,000 square feet. And the suburbs aren't, or downtown's not the only ones doing it. We're seeing it in the suburbs as well. I actually just wrapped up a sublease transaction where we were able to come in and secure a space at about 40% of what the headline rent is. I think as we continue into 2021, we're going to see more and more of those hit the market. I have a question for Kelly. So Kelly, with the Amazon effect in full force and online shopping seeming to take more and more market share, it's interesting to me that the vacancy rate is still sub 10%. Do you think that's a reflection on lack of good product? Or am I just reading too much into this whole online shopping thing?
Yeah, so basically I think you're reading too much into it a little bit. The vacancy rate for 2020 was 8%, which did grow from last year. But onto my trends, we are seeing this year a lot of the big box stores closing, but they are being repurposed. Could be a reason because of Amazon. Is still there. Like for example, we had the Walmart in New Berlin. So that's being repurposed into Burghart's, and then also the city of New Berlin is putting a rec department there. So that's a great example of, yes, retailers are closing, but they're being repurposed. Another good example is, I mean, everybody likes the experience. So retail is evolving more into an experience. They like to feel the goods. They like to be in the store. They like to get it the day of. So that's another good example. And then, I mean, retailers are switching right now to try to follow kind of the 2-day shipping or the quick shipping that Amazon has. One thing I can say is that retail is not dying. Moving on to Adam, I have a question for you. Do you think we will see more manufacturers on China due to legs in the supply chain because of COVID?
Oh, what a great question. Are companies going to come back from China to the supply chain? Yeah, absolutely. And it's actually ongoing. And not just China. We have manufacturers in Vietnam, Korea, even India, Mexico, Canada, and they're all starting to look at coming back to the United States. Some of the companies of notable name would be Caterpillar, GE, Intel, Polaris. Boeing brought 7,000 employees back to the US, GM 13,000, even Apple brought 22,000 employees back. What we've seen though, it's not across the market. Biotech, pharmaceutical, electronics, auto parts, they've really been leading the charge. We're hoping more long-range production does come back to the US and this trend continues. Actually, something I noticed, and Kelly just brought it up again, and I love it. So a takeaway I have today, retail isn't dead. I absolutely love that. It was a curiosity of what's going to happen to retail and all the repurposing and changing. I love it. That's my biggest takeaway from this whole event. Gretchen, do you have a takeaway?
My biggest takeaway for 2020 is that there is just so much capital out there. So if you have concerns that there won't be enough people to buy your building, rest assured there is plenty of capital looking for all the asset classes. What about you, Ben? What's your takeaway?
Yeah, I mean, 2020 didn't turn out to be the year that I think we all were anticipating. We saw a number of changes on the office side as well. And I think while it's continuing to evolve, similar to retail, office isn't dead. So, and well, we're social beings, we're meant to be around each other. And while it's hard to track, I mean, collaboration doesn't happen on Zoom. So it needs kind of that interaction of people coming into the office, asking questions, helping each other solve problems. I mean, for example, I was having a challenge putting this deal together earlier this year, and actually ran into someone on our development team on the way to the hallway. Brought them up to speed on kind of what we were doing, what the process was, and what the deal was. And we're actually now we're under contract. We're scheduled to close in February. So I mean, that would not have happened if I was sitting at my house on Zoom. So it's interesting. So things are changing. Yeah, Kelly, what about you? What's your major takeaway?
Yeah, so my major takeaway, sorry, I have to go back to retail some more. My major takeaway is that COVID and local and national retailers closing or struggling right now, we're really not seeing a flux in asking rents or in rents right now. Deals I'm doing, they are at the same price point that I was doing last year. We're seeing a lot more landlords kind of being a little bit more flexible with free rent or how can we get this tenant up and running. But still the price per square foot is in line with what we've seen over the years.
Christine, love it. Back to you, Pam. Go Bucks.
Thank you to all of our presenters and their teams for putting together today's program. As always, despite a global pandemic, Tracy, Jim, and the teams at CARW and NAIOP have put together an incredible program. Thank you to everyone involved, including our amazing sponsors, First American Bank, Altius Building Company, Cushman & Wakefield Berkey Company, and Wisconsin Crew. While the presentations are over, we invite you to stick around and network. Thank you for attending and happy holidays.